Well, this week, softer than expected CPI data sent stocks rallying. The data is encouraging to investors ahead of the Fed meeting next month, and their confidence is showing in different assets, specifically small cap stocks, maybe having their day in the sun. Bet to outpace the S&P 500. To tell us more, Sam Stovall, CFRA Research Chief Investment Strategist, joins us today. Sam, before we get into the small caps, I want to get your view on the market moves that we saw this week. A huge rally coming on the back of a softer than expected CPI print. How much of that was justified, or you think the market's kind of getting ahead of itself a little?
Well, Akiko, I think it is justified, but you always have to wonder whether it's simply a short covering rally. I think what has kept down the small caps in this early part of this bull market has been the continued hawkish actions and rhetoric by the Fed. Because if you go back to the early 1980s when the Russell 2000 first came out, basically looking at all bull markets, they were accompanied by a decline in interest rates, except for the 1988 bull market. That one, we still saw higher interest rates, but this time around, certainly very much on the upscale for interest rate hikes. So I think that's been holding back the small caps, but from a valuations perspective, they look very attractive. And I think investors are chomping at the bit, waiting for the gate to open.
So Sam, as you look within smaller and mid caps then, which ones have the most room to run?
Hey, Rochelle. Well, those areas that have done very well, that you can get sort of an idea of which ones are favored by the market based on how well they've done in this past week. Healthcare, financials, consumer discretionary were the three best performing S&P small cap 600 sectors. And the only one that declined was energy. And then sort of pulling the leaves of the artichoke back a bit, you can see consumer electronics, life sciences, tools, and passenger airlines, along with hotels and personal care products, did very, very well, rising by double digits, whereas a lot of the groups in the energy space were in negative territory.
All of this comes against the backdrop, Sam, of what you could argue is still an uncertain one in the economy. On the one hand, you've got inflation pulling back. This week, we saw yields pull back in conjunction with that. And yet you've still got this statement coming through from Fed Chair Powell last week, who said, look, I'm not sure that the monetary policy right now is restrictive enough to bring inflation back down to 2%. So what expectation do you operate under if you're an investor?
Well, I guess you sort of tiptoe through this situation, because add to it comments from your prior guest talking about a slowdown in consumer spending, cautiousness about a possible recession in 2024. And we know historically that while the S&P has declined about 35% on average during market declines associated with recession since 1980, small caps have fallen by about 40%. So, they tend to be more vulnerable. But I would say right now, at least in the near term, this market is willing to climb this wall of worry because we're in a very favorable seasonal spot right now. And also the full election year for first-term presidents has been positive every time since World War II.
And Sam, as you look at the holding pattern for the Fed now, especially with the latest data showing perhaps it can take its foot off the brakes here, a lot of people thinking, look, the worst is behind them in terms of Fed rate hikes, but then markets jumping ahead to potentially 2 rate cuts, perhaps by mid-2024. What are your opinions on that? Are they jumping the gun here?
Yes, and no, you're not leading the witness. I do believe that they are jumping the gun. Our feeling is that even though on average the Fed has started to cut rates 9 months after the last rate hike, that I think that we're likely to see the first rate cut take place in the third quarter, and that it'll be one cut in Q3, one cut in Q4 of 2024, because the Fed has said over and over again, they don't want to make the same mistakes that were made in the 1970s, where they changed their course too quickly, thinking that the smoldering embers were ready to go out rather than reignite.
Well, appreciate you, as always, for joining us. Great to see you. Sam Stovall, CFRA Research Chief Investment Strategist. Have a great weekend.
Thanks.